Hey everybody, it's Ian Beamer with Guaranteed Rate. Hope everybody's doing well. Hope everybody's staying healthy. Wanted to bring you the August market update for 2022. We don't have a Fed meeting this month. Next meeting isn't until about a month from now, September 20th, 21st. And the markets are starting to price in an expectation, about a 50% expectation of about a 0.75% increase at that September meeting. So we'll see what happens. Mortgage interest rates are starting to tick up slightly over the last few days. Um, it's hard to predict, but generally speaking, that's what the market's telling us we should expect at that September meeting so far. The Wall Street Journal conducted a poll about a month ago in July, and they've been conducting this poll every month. But as of July, they polled economists in the US and they asked, what are your expectations that we will see a recession in the next 12 months? About 50%, 49% of those economists polled in July said that they do believe we will see a recession in the next 12 months. So that's up about 5% from the same poll that they conducted in June. And then they conducted the same poll in May. And I believe the increase is significant, about 15% more from the number of economists that thought the same thing in May. So, will we see a recession? Nothing's guaranteed. Anything can happen. But if we do, what does that mean for the housing market, for interest rates, for home prices? Interest rate wise, I actually think interest rates should come down theoretically if we do see a recession. So just like the Fed is raising interest rates now to slow down inflation, slow down spending, get inflation under control, if we do see a recession, that means they have to do the reverse. They have to spark the economy to kind of spur spending again, get you buying consumer goods, get you traveling, get you spending money again, and get corporations to spend money. Because one of the negative aspects of a recession would mean likely that unemployment rate would go up. So right now we're sitting at an unemployment rate of about 3.5%, which is really low, very healthy economy. If we see a recession, we may see that rate tick upwards. So we lower interest rates, corporations start spending money, they start buying more goods, they start producing more, they start hiring more people again. So theoretically, that's the way it's supposed to work. So recession likely would not mean lower prices on homes, which should not negatively affect home values. And in fact, historically, we've seen the reverse happen. So if interest rates come down, and this makes sense, if interest rates come down, consumers and corporations will start spending more, driving up demand, leading to home appreciation. So, there are a lot of consumers, a lot of even realtors that I speak with that still think that, we've got a shot at seeing 2008 over again. I keep saying this, but I don't think that that's going to happen. 2008 was kind of a unique event. The demand going into 2008 was manufactured by the mortgage industry, by very liberal lending. There were programs that let you do 100% financing, maybe even more than 100% financing, even on investment properties. No skin in the game. Oftentimes, no employment information, no income information in the file. Sometimes no asset information. All of that has gone away. So that's one of the reasons I don't think that we'll see 2008 over again. But quite simply, the reason we're not going to see 2008, in my opinion, is because we don't have any inventory. Inventory is still extremely low. Right now, nationally, we're sitting at about 3 months of supply. In the Chicagoland market, we're sitting at about 1.8 months of supply. And again, an average market, a flat market, a stable market, where it's not really a buyer's market, not really a seller's market, is somewhere between 5 and 7 months of supply. So we've got a long way to get there. We need that to go significantly over that 7 months of supply to see rates start to dip. Um, I don't see that happening anytime soon. Um, we've seen existing home sales predictions for 2022 come down. We're starting to hit pre-pandemic levels. I think 2019 we saw about 5.3 million homes sold, and they're expecting somewhere around 5.1 million homes sold for 2022. During the pandemic, even last year, we were about 6.1 million homes. So we're down significantly from the pandemic levels, but we're it was still a healthy market in 2019. So um, existing home sales is still a strong market. New construction is starting to slow down. Obviously, labor is up because unemployment rate is so low, and the price of materials is quite high. So builders are starting to slow down their production of new homes. So we're not seeing those hit the market. Obviously, we've got existing home sales coming down. New construction homes are starting to slow down as well. And we don't have foreclosures. That's the third part that leads to inventory. Foreclosures have been coming down every year since 2010. Um, I think in 2019, we were about almost 500,000 foreclosures. In 2020 and 2021 combined, we were about $100,000, even less than that combined. And the reason being is because of forbearance. A lot of you have heard of this term, but the government came out with a CARES Act as a result of the pandemic and introduced this term forbearance for a lot of us, which allowed homeowners to restructure their mortgages without any penalty to their credit. So if you were late, if you were impacted by COVID, they came out with a program that basically lets you restructure that debt, tack that those missing payments onto the end of the loan. You can add a little bit to every month, lower the interest rates, because interest rates obviously were extremely low in 2020, 2021, far lower than they ever have been prior to the pandemic. So that forbearance program was extremely successful. At one time, we had about 12% at least of government insured mortgages in forbearance. And that was probably May, June of 2020, right at the height of the pandemic, or at least the initial shock of the pandemic. And obviously, restaurants were closed. Nobody was traveling. It was hard. It was a very difficult situation. So the government did step in. You've got to applaud them for that. So that forbearance program was a tremendous success. So again, about 12% at one point at its peak of all mortgages held, at least for the government issued loans, were in forbearance. And right now we're sitting under 1%. It's about 0.81% of all mortgages held are still in forbearance. So the program worked. Foreclosures, distress sales are significantly down. So that's not going to get us more inventory either. And I think the existing home sales coming down is simply a result of no homes to sell. It's not a reflection of a decreased demand for homes. The demand for homes, I believe, is still there. And again, if we do see a recession, obviously, if some people lose their jobs, they're probably no longer in the market. But if interest rates come down, that could spark the market again. So, obviously it depends on your market. Talk to a realtor in your area. I'm speaking very broad terms, speaking generally across the nation and in the Chicagoland market. But the one bedroom condo market is significantly different than the 7,000 square foot single family home on the North Shore. That's we're not talking about the same buyer. Those two buyers are not experiencing the same situation. So talk to a local real estate agent in your market. There's all kinds of things that can affect the market to your conditions. Are they expanding schools, or is there a new housing project coming up a mile down the road? Is a major market NFL football team moving to your town? All these things could affect your housing market. So talk to a real estate professional. If you need a recommendation, I'm happy to help. But I appreciate you checking out my video. Let me know your thoughts. I'm happy to hear from you. Ian Beamer, Guaranteed Rate. Thanks for checking it out. Look to hear from you soon. Have a great day. Bye.